Hello, good evening. Welcome to CA Final SFM April MTP. So we are going to take remaining questions of CA Final SFM April 2023 MTP. In case if you don't have this MTP, please go to our website vino.in and download the MTP from our website vino.in. You will find on the home page there is a free resource section. So you will find the question paper and the answer also. So I request all of you that first you download this paper, take the printout of this paper, keep it in front of you, because today we are going to take question number 4, 5 and 6, which are very important, and they have been asked in the exam, they will be asked in the exam in the past. So trust me, you have to really follow my instruction today. Take a notebook, take a pencil, pen and calculator and this question paper SFM April 23 MTP in front of you. Okay, so here we are going to start this amazing question number 4A, which was already asked in the past exam. So it is a past exam question repeated in the MTP, and this question is based on adjusted present value. Normally they don't ask question on this, but this was a little exception. If the student has not studied APV method, he will not be able to solve. So this is a question of adjusted present value under capital budgeting. The management of multinational company TL Limited is engaged in the construction of infrastructure. Project A, proposal to construct a toll road in Nepal, is under construction of the management consideration. So the project is toll road in Nepal. The following information is available. The initial investment will be in purchase of equipment costing rupees 250 lakhs. So this is my initial investment. Life of the equipment. This equipment will have a life of 10 years. For depreciation purpose will take 10 years. The depreciation on the equipment will be charged on straight line basis. Very easy. Straight line will make your calculation very easy. EBITDA, earning before interest, depreciation, tax and amortization, will be collected from toll road is projected to be USD 33 lakh per annum. So this is your earning before interest, tax, depreciation and amortization, 33 lakh per annum. Underline for a period of 20 years. Now students, please be careful. Equipment has a life of 10 years, but the collection of toll revenue will be for 20 years. So it is a 20-year project. For depreciation purpose take 10 years, but for cash flow purpose take 20 years. For cash flow purpose take 20 years. To encourage investment, Nepalese government is offering a 15-year term loan of USD 150 lakh at an interest rate of 6% per annum. So what you can do, you can take a loan for 15 years. Amount of the loan is 150 lakh and the rate of interest on the loan is 5%. The interest is to be paid annually. So every year you are going to pay 6% of 150 lakhs as interest, 9 lakhs per annum. For 15 years you have to pay interest. The loan will be repaid at the end of 15th year. In the 15th year you will repay 150 lakh. So all these figures will be required for calculation purpose. You have to know exactly the timing of the cash flows. Depreciation will be for 10 years. Cash flow will be generated from the project for 20 years. loan is for 15 years. So accordingly, do the calculation. The required rate of return for the project under all equity financing, underline all equity financing, is 12% per annum, which means the cost of equity is 12% if there is no debt. If there is no debt, this is called cost of equity of an unlevered firm. In case of adjusted present value method, first we assume, only assume, hypothetical assumption that the project is fully financed out of equity, and therefore calculate the cash flow from equity's point of view and use the cost of equity of an unlevered firm for discounting purpose. So fortunately, this 12% is given to you. And in case if you are using any debt, the tax advantage of using debt will be separately calculated and will be added to the base NPV, that will give you adjusted NPV. So for that purpose, they have given you post-tax cost of debt is 5.6% per annum. Underline the word post-tax. So 5.6% is per annum. Corporate tax rate is 30%. If I ask you what is the pre-tax cost of debt, so you will say pre-tax cost of debt is 8%. The pre-tax cost of debt is 8%. This is used to calculate the present value of tax shield on interest. This will be required for calculating the present value of tax shield on interest. You are required to advise the management on the viability of the proposal by using adjusted present value method. And now you see they have given you some factor also. 12% 10-year annuity factor, 12% 20-year annuity factor, 8% 15-year annuity factor, and 8% 15-year single cash flow factor is given. So 12% will be required for PV of cash flow, 8% will be required for PV of cash flow related to debt financing. So that is why two discount rates are given. I hope you have done this question in your classes. If not done, then do it now and also mark it very important. Trust me, this question can be asked in the exam. So in adjusted present value method, what we do, we first calculate the value of the project as if it is financed by equity. I will dictate everything as if it is financed by equity. Use cost of equity of an unlevered firm as discount rate. But the firm is not using only equity, the firm is using debt also. So you will add the present value of tax shield on interest on debt. Because you are using debt, debt has an advantage, you pay interest, and on interest you get tax shield. This will remind you of one chapter done in the intermediate FM, value of an unlevered firm and value of a levered firm. You might have studied, I don't know, value of a levered firm is calculated as if it is all equity financed by using the cost of equity of an unlevered firm. And then if it is a levered firm, because the firm uses debt, it gets tax advantage. They will add the present value of tax shield on interest. To that extent, the value of a levered firm is more than the value of an unlevered firm. We have used the same logic in adjusted present value method also. So I am going to dictate line by line what is APV, how the calculations will be done. In this question, lot of things are directly given to you. Had it not been given, then we would have computed it. So what you do, first you write down one small note. This is not for exam, this is for understanding, and this is for writing a theory question in the exam if they ask you what is adjusted present value method. So start. I'll dictate slowly. Note on adjusted present value method. Note on adjusted present value method. Note on adjusted present value method. Right. APV method is the NPV of the project. APV method is the NPV of the project if financed solely by equity. So first you assume, first you dream as if the project is financed solely by equity and calculate NPV. But if the firm is using debt, the NPV will be higher to the extent the present value of all the benefits of financing plus the present value of all the benefits of financing. So that is APV method. NPV assuming equity financing plus benefits of debt financing. Steps write down. Step number one, compute NPV. Compute NPV assuming that it is fully financed by equity. Compute NPV assuming that it is fully financed by equity. Compute NPV assuming that it is fully financed by equity. Now write down, discount the cash flow using cost of equity. Discount the cash flow using cost of equity. Discount the cash flow using cost of equity. Now how do you get cost of equity? That is important. In this question it is given. If not given, then this line will be required for your next exam. Cost of equity is based on unlevered beta. Cost of equity is based on unlevered beta. Cost of equity is based on unlevered beta. Unlevered beta means beta of a firm which does not use debt. How to calculate unlevered beta? Please refer portfolio management chapter. We have discussed there, so today we will not discuss it here. We have discussed how to get unlevered beta in portfolio chapter. This is called base case NPV. So this is called base case NPV. If the firm is using only equity, what will be the NPV? That is base case NPV. Step 2, write down, compute the issue cost or the flotation cost. Compute the issue cost or the flotation cost. This is already in today's value because issue expenses will be incurred now, so it's already present value and represents an outflow. If there is any flotation cost, that will be treated as an outflow in year 0. Very easy. In this problem, this line is not required, but suppose in your exam something like this happens, you can consider that in year 0. Because it is in year 0, discounting is not required. Step 3, write down. Step 3, write down, compute PV of tax shield. Compute PV of tax shield on interest on debt. This is the benefit of debt financing. PV of tax shield on interest on debt. Now what about the discount rate? Discount rate will be used pre-tax cost of debt as discount rate, because we just require time value of money. We will not use cost of equity here as a discount rate. Cost of equity includes risk premium. As far as interest on debt is concerned, it is predetermined. So it does not have the risk element. It does not have the uncertainty element So I just need a discount rate which is purely time value of money, does not include the risk premium, and that is your pre-tax cost of debt. Some students are asking me why we are using pre-tax cost of debt. So I have written this line. In case if you want to write down why we are using pre-tax cost of debt. Not relevant for the answer, but for understanding. Please write little fast. The logic for pre-tax cost of debt. The logic for pre-tax cost of debt lies in the assumption that so what is the logic? Cash flow arising out of tax saving is as risky as cash flow from the debt. Cash flow arising from tax saving is as risky as cash flow from the debt. Now one more important line. If we are very sure of receiving tax shield, that means you are dead sure, 100% sure that yes, tax shield is 100% certain. There is no uncertainty. Company is bound to receive tax shield on interest. We will have sufficient taxable income in future and therefore will get tax shield. So what the company can do? If you are very sure about receiving the tax shield, we can use risk-free rate of interest. We can use risk-free rate of interest. We can use risk-free rate of interest. And now write down this step number 4, adjusted NPV. So how will you get the adjusted NPV? First you calculate base case NPV using cost of equity as a discount rate, assuming only equity financing, minus any flotation cost if given, not in this problem, and plus PV of interest tax shield, Now institute in the answer has covered the entire impact of financing, so therefore there can be an alternative answer also. Write that also, because we have to appear for the exam also. So we have to be on the same page as that of the institute. Right, note, instead of calculating PV of interest tax shield, we will solve by both the approaches. We will only consider tax shield on interest, and we will also consider PV of entire impact of financing by debt. PV of entire impact of financing by debt. Up to this you don't need to write in the exam. This was for understanding. This was for writing a note on APV. So APV method first assumes that project is fully equity financed. Compute NPV as if it is only equity finance, and if the firm is using debt also, then you will also take into account the benefits of debt financing, which is usually the tax shield on interest. For exam purpose, you will start from step number 1. Please write down calculation of CFAT. We will divide into 2 blocks for year 1 to 10 and year 11 to 20, because year 1 to 10 you will get depreciation deduction, but 11 to 20 depreciation will not be there. First point A, write down earning before interest, tax, depreciation and amortization, EBITDA, which is already given in the problem 33 and 33. Question in front of you. Less depreciation per annum. 250 is the cost of the asset. Life of the equipment is 10 years. So first 10 year depreciation will be 25. Second 0. So we'll get PBT. We'll get PBT in the first 10 year 8, 11 to 20, 33. Then we'll write tax at the rate of 30%. tax at the rate of 30%, 2.4 and 9.9. CFAT would be, calculate and tell me. This is your cash flow before tax depreciation and this is your tax outflow. So what you do, take A minus D, or if you want C minus D plus B, whatever suits you, whatever helps you to understand, you can write and give me the answer 30.60 and 23.10. So this is my CFAT if it is only equity finance. We have not considered here interest or repayment of loan. That will consider as a separate calculation. So when you are assuming it is only equity finance company, where is the question of considering interest and repayment of loan in the cash flow right now? We'll consider it later as a benefit of debt financing. Now write down step 2, base NPV. Base NPV means NPV of an all equity financed firm. NPV of an all equity financed firm. Come on student, write down the format. If you have any query, you can ask me right now. If you don't have query, draw the format. Year, particular, cash flow, PV factor 12% is given for equity. Otherwise, we'll have to find it out ourselves using unlevered beta. Cost of equity, if not given, use this formula RF plus beta unlevered into RM minus RF. But in this question, it is given. Otherwise, the student will use this formula. This question is really very important. I hope you have noted it down. Year 0, write down initial investment 250. Year 1 to 10 CFAT. As per step 1, first 10 year 30.60. Factors are given in the problem. So good news is that you don't have to calculate the factor. Factors are given in the problem. So just copy from there 5.650 and multiply. You get 172.89. Year 11 to 20 CFAT. Again we have already done in the step 1, 23.10. Look at your question book. Factor is given 7.469 is given. That is for 20 year minus 5.650, that is for first 10 year. So the difference is the factor for 11 to 20 years. Multiply. Don't directly take 7.469, you will make a mistake. So 40.169. Take the total of this. This gives you base NPV. So if it is only equity finance firm, the NPV is negative. But wait, this firm is using debt also. So there are some benefits of debt financing. Step number 3, write down. Step number 3, PV of impact of financing by debt. PV of impact of financing by debt. In bracket must write down, in bracket you must write down all aspects of loan considered. All aspects of loan considered. All aspects of loan considered means we will take the loan amount, we will take the interest, we will take the tax shield on interest, we will take the repayment of the loan also. So write down this table. First column year, particular, cash flow, but be careful. Now I am going to take 8% as a discount rate. PV factor at 8%. Sir, how did you get 8%? Post-tax cost of debt is given 5.6%. Tax rate is given 3%. So pre-tax cost of debt will be 7%. Sorry, 8%. So I will use 8% discount rate. Use pre-tax cost of debt. Note is already given to you for that. We are assuming cash flows are as risky as the tax shield is as risky as the cash flow which is being generated by the loan. So loan amount is 150. Loan amount is 150. Interest will be paid every year. 6% of 150. 9. If you look at your question book, the factor is given 8.559 given. Multiply into 9, 77.031. Please reply if you have a doubt. 1-15, you will get tax shield on interest on 9 at the rate of 30%. You will get 2.70 as tax shield inflow into same 8.559. How much you are getting? 23.109. Okay. Year 15, repayment of loan. Repayment of loan is 150. Repayment of loan is 150. So 15th year factor is 0.315. This is also given in question book. This is given in the question paper. Multiply 47.250. Now the student will give me the total of last column. Only when you will give me the total, I will go ahead. Otherwise, I will keep sitting. Total of the last column. Yes, please. Total of the last column is how much? This is 48.828. This is the PV of impact of debt financing. If you go with debt also, this is the PV of debt financing. Now write down adjusted NPV. Now write adjusted NPV. Adjusted NPV will be base NPV minus flotation cost plus any benefit of debt financing. Right hand side rupees in lakh. Sorry, USD in lakh. Because this question has USD. USD in lakh. Base NPV negative 35.0911. Flotation cost is not there. Debt financing is there. PV of debt financing 48.828. So now take the total. This total is called adjusted NPV. So total of A plus B is positive 13.737. If I take all cash flows into consideration, my adjusted NPV is positive. So I will write a note. Since adjusted NPV is positive, TL Limited should accept the project. TL Limited should accept the project. This is one answer. The institute has given one more answer, and we will also follow the same. Instead of taking all cash flow associated with debt financing, we will only consider the benefit of debt financing in the form of PV of tax shield on interest. Very good, Mr. Sagar. Your answer is right. Enjoy. Write down one more note. We'll solve it one more time. Lengthy question but manageable, and you'll get full 8 to 10 marks. Alternatively, instead of PV of overall impact of financing, the PV of impact of tax shield on interest is considered. PV of impact of tax shield on interest is considered. Then adjusted NPV will be. So now I will only consider the PV of tax shield on interest already computed earlier. You can check there. We can write the same figure already computed. Write down base NPV. Base NPV, write 35.0911 negative. PV of tax shield on interest already calculated in the step number 3. already calculated in the step number 3, 23.109. Now you tell me the total. Again, please reply total. So what will be adjusted NPV if I only consider the PV of taxation on interest? 11.9831. 11.9831. Write down advice. Since NPV is negative, project should not be accepted. Since NPV is negative, project should not be accepted. If this question comes in the exam, write both answers. Okay, write both answers. You can't trust institute. Okay, so this is right answer. Thank you very much those who are replying. Any query on this now? Now we'll come to question number 4b. Question number 4b was on mutual fund. This is also past exam question. Write down here past exam question. I think somewhere in the year 2015 this question was asked, and now they are asking in the MTP also. A very easy question. Let us solve it together. Take out your notebook, keep the calculator ready and follow me. There are two mutual funds D, K, each having closed-ended equity scheme. So it's an equity scheme. NAV on 31/12/2014. The institute have not changed the date also. The same date was appearing in this 15 exam. NAV on 31/12/14 of equity scheme of D mutual fund is 70.71. Now out of the 70.71, 99% is equity and 1% is only cash, and the balance is cash. And that of K mutual fund is 62.50 NAV, 96% is equity and balance in cash. So first we will find out how much is equity component and how much is cash component in both the mutual funds. Following is the other information. Equity scheme DK, Sharpe ratio. The formula is R minus RF upon sigma. Trainer ratio R minus RF upon beta. And then the standard deviation is given to you. Sharpe ratio, Trainer ratio, standard deviation. There is no change in portfolio during the next month. There is no change in portfolio. So portfolio remains the same. Portfolio remains the same means it comprises of the same equity share and some cash. And the annual average cost is rupees. Underline the word annual. Annual average cost is rupees 3 per unit. 3 rupees per year divided by 12 months. So that is 25 paise per month is your expense. 25 paise per month is expense. Because you incur 25 paise expense, your cash balance will reduce by 25 paise. Cash balance will reduce by 25 paise. Now the question is, if the share market goes down by 5% within a month, share market goes down by 5%. So what will happen to the equity? The share market goes down by 5%. The equity will go down by 5 into beta. The equity will go down by 5 into beta. these two mutual fund comprises of 99% equity and 96% equity. Okay, so the value of the equity portion will decline to the extent of 5 into beta, which means we need to find out beta from this information. We need to find out beta from this information. Now it says calculate expected NPV after a month for both the schemes. So you have to again find out the NAV. NAV will be equal to equity plus cash. Equity will fall to the extent equal to 5 into beta. Cash will fall to the extent 25 paise, and that will give you NAV after 1 month. So the missing figure basically is beta. Once you are able to calculate the beta of these two schemes, once you are able to calculate the beta of the two schemes, you will be able to apply the beta and find out what will be the revised value of equity portion, and you will be able to solve. Consider 12 months in a year and ignore number of days. So we will take 1 month for calculation, and for expense per unit I will take 3 rupees divided by 12 months. Anyway, this is not very important. So first step 1, write down. First we will check at the beginning of the month how much is the equity portion and how much is the cash portion. Right. Decomposition of funds in equity and cash component. Decomposition of funds in equity and cash component. Right hand side 2 columns, D mutual fund, K mutual fund. Question in front of you. Take the printout of your MTP April 23. Keep it in front of you. We are solving question number 4B. NAV on 31/12/14. First and second paragraph. Second paragraph you will find 70.71, 62.50 less percentage of equity. How much is equity? 99%. How much is equity in K? 96%. So can you find out equity element in NAV? So simply multiply 99% of 70.71. Yes, Mr. Dongre, please reply. What is equity element in first mutual fund? 70. Second mutual fund, yes, second mutual fund, reply please fast. 60 rupees. So can we find out the cash element? Yes, cash element in NAV A minus C. A minus C, 71 paise. Very good. And second one 2.50. Very good. So this is my existing equity and cash. This will fall by 5 into beta. This will fall 5 into beta once we calculate beta, and this will fall by 25 paise because of expense incurred, and that will help me to calculate the revised NAV after 1 month. So the main task in this question is to find out beta. So write down below step number 2, calculation of beta. Calculation of beta. Come on, calculation of beta. All of you know Sharpe ratio is R minus RF upon standard deviation. So R minus RF will be equal to Sharpe ratio into sigma, and trainer ratio is R minus RF upon beta. R minus RF you will get from previous calculation. Trainer ratio is given, so we can find out missing figure beta. So first what I'll do, I'll find out what is the value of R minus RF using Sharpe ratio, and using that R minus RF and trainer ratio we can find out the beta value, right? Start. Point number A, D mutual fund. Point number A, write down D mutual fund. Under D mutual fund, Sharpe ratio write down. Sharpe ratio 2 is equal to R minus RF upon sigma D is equal to R minus RF upon standard deviation of D mutual fund is 11.25. So cross multiply 2 into 11.25 will give you 22.5. So R minus RF, expected return minus risk-free return, is 22.5. Use this value in the next ratio and find out the beta. So trainer ratio equal to, write down the equation, question in front of you, 15 is equal to R minus RF upon beta of D. This 22.50 already calculated here. This you shift here. So cross multiply beta of debt into 15 is 22.5. So beta of debt will be 22.5 divided by 15. Come on, reply. What will be beta of debt? What will be beta of debt? 22.5 divided by 15. That comes to 1.5. Very good. Same way, please calculate and give me the beta of K mutual fund. Yes, start yourself. In the same way, student will now reply, what is the beta of K mutual fund? Kindly participate. Everybody. Beta of K. Beta of K mutual fund. Here also write down Sharpe ratio equal to 3.3 equal to R minus RF upon sigma K, this is sigma, standard deviation K, is equal to R minus RF upon 5. Cross multiply R minus RF is 16.5. Very good. Now tell me what will be beta of K mutual fund. Trainer ratio is 15 is equal to R minus RF upon beta K is equal to 16.5 upon beta K. So student will reply, what is beta of K mutual fund? Come on, come on. Yes, beta of K mutual fund. 16.5 divided by 15. 16.5 divided by 15, and that is 1.10. Very good. 1.10 is right. Now write down decrease in the value of equity. Decrease in the value of equity. So equity value will decrease to the extent of 5 into beta, because market has gone down by 5%. So the value of the equity will go down by 5 into beta. So point A, write down market goes down by 5%. Market goes down by 5%. Then write down beta 1.5, 1.1. 1.5, 1.1. Now you write down, therefore equity goes down by, Therefore, equity goes down by, multiply the two, 7.5%, 5.5%. Value of the equity element will decrease by this percentage. Okay. So this is my next step, number 4. Balance of cash after 1 month. Balance of cash after 1 month. You will get step marking. Write your answer in more and more number of steps, easy steps, D and K. First write down cash in hand. You can just write D and K. Cash in hand on 31/12/14. Cash in hand on 31/12/14 is 0.71 and 2.50. Less expense per month, 3 rupees divided by 12 months. 3 rupees divided by 12 months. 0.25. Cash balance after 1 month per unit. Cash balance after 1 month per unit, A minus B. A minus B, 0.46. And second column, come on, second column, 2.25. 2.25. Now write down last step 5. This way you have to divide the answer into small steps. So if it is a 5 mark question, you will get full 5 marks. 10 mark question, you will get full 10 marks. Okay. Just taking everything on calculator and directly putting it, for our exam purpose, it will not give you marks. Two things are important: learning the concept also and learning the presentation part also. So student will write step 5, NAV after 1 month. NAV after 1 month, right hand side 2 columns, D and K. First write value of equity after 1 month. Value of equity after 1 month. So first you will take value of equity on 31st December 2014 minus 7.5%. This was the value of equity already calculated in some earlier working note. Minus 7.5%. Just write down minus 7.5%, if that helps you to understand. So that comes to 64.75. And similarly, this is 60 minus 5.5% will be second answer. Come on, 60 minus 5.5%. That is 56.70. Cash balance write down. Cash balance. Go to step number 4, you will find 0.46, 2.25. Very good. Very good. Those who are replying, you are really good student. Now write down NAV after 1 month. Just add these two numbers. First answer will be 65.21 and second answer will be 58.95. Check, is it 58.95? So this is my answer of question number 4B. Now we'll take a very important question. This question is from portfolio chapter, and this question is a repeat question. It was asked in the exam, but they have made some changes in the problem. Similar problem we have done in the class, but this time they have made some changes in the problem. Actually, they have made it a easier problem than what it was asked in the exam. Start. Mr. A owns a portfolio with the following characteristic: security X, security Y, and risk-free security. Beta of security x 1.6, y is 1.8, risk-free as you know is 0. Even if it was not given, suppose it is not given, you will assume to be 0 beta for risk-free security. Expected return 15%, 16%, RF is 7%. If Mr. A has rupees 2 lakh to invest, 2 lakh, we will call it own fund. Own fund is 2 lakh. Sales short rupees 1 lakh of security B. So what happens in short selling? You will sell the stock now and buy it later. And how do you sell it now? By borrowing it from somebody else. That is called stock borrowing and lending mechanism. So when you sell the stock today, you will get a cash flow of 1 lakh. So plus 1 lakh. So total amount available with you is 3 lakh. 2 lakh own fund and 1 lakh from short selling B, and purchases rupees 3 lakh of security A. So what is the position on stock A? Long position 3 lakh. What is the position on stock B? Short position amount 1 lakh. Short position is negative, long position is positive. What is the sensitivity of Mr. A's portfolio? Sensitivity of Mr. A's portfolio means, given the data, beta of portfolio is weighted average beta. Weighted average beta. These are the beta of X and Y. I have written A and B, it should be X and Y, okay? X and Y, and just multiply by the weights. So 1.16 into weight of X plus 1.80 into weight of Y is equal to portfolio beta. This will be your first answer. You get 2 to 3 marks for this much effort, but the important thing is, what is the weight of stock A and stock B? That I will tell you later. You keep thinking. Keep thinking what is the weight of X and Y. Now they have just asked the same question by adding one more variable. Listen to me. Suppose Mr. A has already got 2 lakh. Own fund 2 lakh. Now it says, if Mr. A borrows rupees 2 lakh at the risk-free rate and he borrows 2 lakh, so he has got 4 lakh. Earlier in this question, he had own fund of 2 lakh. Now before short selling B, he has total 4 lakh rupees in his pocket, and invest the amount he borrows. Invest the amount he borrows along with the original amount of 2 lakh. Along with original amount of 2 lakh. So total is 4 lakh. In security X and Y in the same proportion as described in part 1. In part 1, what had happened? We had 2 lakh in X. We had 2 lakh in X long position, and we have 1 lakh short in Y. So basically the ratio is, if you have 2 lakh rupees, you are short selling half of that. So the ratio is, if you have 2 lakh rupees cash with you, you will short sell 1 lakh of B. Now on the left side of the screen, we have 4 lakh rupees cash with us. What will be the short selling of B? We always short sell half of what cash we are holding before that short selling. Earlier it was 2 lakh versus 1 lakh. So now it will be 4 lakh versus 2 lakh short selling of B. So once I do short selling of B, I will get 2 lakh rupees cash. So I will have 6 lakh rupees with me now. 2 lakh own fund, 2 lakh borrowed funds, 2 lakh from short selling. So I get 6 lakh. This 6 lakh rupees will be invested in stock Y. So my amounts will be as follows. 6 lakh rupees invested in X, long position. 2 lakh rupees short position in Y, and 2 lakh rupees I will borrow. So this will be my portfolio in the second situation. This will be my portfolio in the second situation. So one student has replied about weights. I will check it later. Just wait. What is the sensitivity of the portfolio? So sensitivity of the portfolio is same, weighted average beta. So you have to recalculate the weight of XY and the borrowing, multiply by the respective beta, and you will get the sensitivity of the portfolio. And the next question is, what is expected market risk premium? So you have to find RM minus RF. You are given expected return, you are given beta, you are given RF. RF plus beta into RM minus RF is expected return. So put the values and you will get the value of RM minus RF. Either you can use security X to answer, or you can use security Y to answer this question. Is it right? So let us check the weights in first answer. Very easy question. Write down answer of question 5A. Own fund is 2 lakh. 5A part 1. First we will solve part 1. So part 1, write down own funds 2 lakh. Short sale of Y 1 lakh. Total funds available 3 lakh. Total funds available 3 lakh. This 3 lakh will be invested in stock X, long position 3 lakh, Y limited short position 1 lakh. This diagram is for understanding purpose. Okay. In the exam we don't have much time, so we can avoid this diagram and directly start with the weights. So write down step number 1, weights. Weight, write down stock calculation and weight. Stock calculation and weight. First, stock X. Total amount invested is 3 lakh. Amount invested in stock X is 3 lakh and total is 2 lakh. Sir, how the total is 2 lakh? How the total is 2 lakh? 3 lakh minus 1 lakh is 2 lakh. The total in the denominator will be 2 lakh. So weight is 1.5, and for Y the weight will be minus 1 lakh divided by 2 lakh, that is minus 0.5. So the student had given right answer. Total should be 1. Should be always 1. If it is not 1, you are making a mistake. Second thing, one trick I will tell you. One trick. Denominator should always be own funds. That is own fund. Do not include short selling amount, do not include borrowed amount. Denominator should always be own fund. Then one more thing you should know. Short selling will have negative weights. So if you have done short selling, it will have negative weights. So 3 things I have dictated for understanding purpose. Total of the weight should be 1. Denominator should be own fund. Short sold item will have negative weight. Now write down step number 2. Sensitivity of Mr. A's portfolio. These are the weights. Beta is given. So I am asking you a question. What is portfolio beta? Multiply this with their respective beta. So beta of X is 1.6 given in question. Weight is 1.5. Beta of Y is 1.8. Weight is minus 0.5. Kindly solve. Yes, please solve. What is the answer for first part? Check the answer. 1.5. Is the answer 1.5? Yes. Now come to answer of part 2. Write down answer of part 2. Own fund is 2 lakh. Borrowing is 2 lakh. So the funds available is 4 lakh. Fund available is 4 lakh. Now there is a condition. Follow the same ratio which was in the previous part 1, X and Y. Previous question, part 1, 2 lakh own fund, short selling 1 lakh. Now I have got 4 lakh rupees with me. What is the short selling I will do for Y? So short selling I will do for Y is 4 lakh. 2 lakh. So short selling of Y will be 2 lakh, so that we will follow the same ratio as in question number 1. Okay, 2 lakh. So the amount available now is 6 lakh rupees. 2 lakh plus 2 lakh plus 2 lakh is equal to 6 lakh. Now write down the breakup once again for presentation. This is only for understanding. Sir, we don't have time in the exam. Then don't draw this diagram. If you have time, then you will draw. If you have time, then you will draw. Okay. So we have investment in X Limited 6 lakh, long position, borrowing 2 lakh, and Y Limited short position 2 lakh. This is our portfolio. Now we have to assign weights. If you take the total of these three, the total comes to 2 lakh. So this 2 lakh I will keep in the denominator for the purpose of weights. Right? Now write down step 1. Same format. Calculation of weight. X. 6 lakh is the investment in X. Divide by total 2 lakh. 3. Very good. Y. Minus 2 lakh divided by 2 lakh. Student has already replied. Minus 1. Borrowing. Minus 2 lakh divided by 2 lakh. Minus 1. Cross check. Total should be equal to 1. Total should be equal to 1. Now, these are the weights. You have to multiply by their respective beta, which is given in the table, and take the total. That will be your sensitivity of the portfolio. So write below step 2, sensitivity of Mr. A's portfolio. Come on, reply now. I will wait for your answer. 1.6 into 3 plus 1.8 into minus 1 plus 0 into minus 1. What is the final answer? Anybody final answer? I am not dictating the answer. You are calculating, I am writing. Okay. But this way of presentation helps us to save lot of time. We have to do lot of homework before coming to the class. This kind of presentation requires lot of effort, time, but it helps us to do fast and there is no mistake. So the answer was 3. Check the answer. Is it 3? Now answer of part 3. Yes, very good. Students have said 3. So next answer is, what is the expected market risk premium? So please write down. Assume that expected return is equal to required return. Assume that expected return is equal to required return. All of you know CAPM calculates required return, not expected return. So we'll assume that whatever expected return they have written, actually they mean required return. So you can either use security X or you can use security Y. You will get the same answer. For security X as per CAPM, come on, reply. 15 is your required return, RF plus beta into RM minus RF. Now I'll put the values. 15 equal to 7 plus 1.60. RM minus RF is called risk premium. RM minus RF is called risk premium. Kindly solve. Give me the answer. Student will solve and give me the answer. So the answer is 5. Market risk premium is 5. If you use Y also, then also the answer will be, for Y also, my expected return is 16. 7 plus 1.8 RM minus RF. So using stock Y also, if you try, RM minus RF will come to 5%. Just try with stock Y. RM minus RF will come to 5. Now we'll come to question number 5B. A very similar question was asked in MTP of November 21. So they are just doing copying and pasting from different sources. That will not help you in the exam, because in exam some new question will come. So I will ask you to practice more and more variety of questions. Okay. So as you know, I am taking FRN SFM batches for CA final. The lectures are available in regular and revision mode. And the lectures are available in 2 languages also. English, Hindi, for both. So it has taken lot of efforts to prepare regular, revision and recording in 2 languages separately. We cover all the questions from study material, past RTP, MTP and past exams. So that way there is a very comprehensive coverage of the entire syllabus. So you can purchase from our website vino.in, and if you like it, you also recommend to your friends. Okay, thank you very much for watching this video. Come to question number 5 now. Very important question. Write down. Very important. One more thing, a lot of students are saying that we should only study from the study material. That is not correct, because you see, this kind of questions are not there in the study material. You have to do a very comprehensive study. This is CA final exam, not inventory management where you will do ABC analysis. That is a wrong guidance to the student. Every question belongs to A category only. There is no B, there is no C. Your life is at stake. Your career is at stake. You can't miss anything. You have to do everything. Don't take chance. Don't take chance in the exam. Anything can be asked. So let us go to question 5B. Otherwise, you will say that I am only giving long lectures. Keep the SFM MTP in front of you. A textile manufacturer has taken floating interest loan of rupees 4 crore. So there is a loan taken of 4 crore on 1st April 18. Always read the problem slowly. The rate of interest at the inception of the loan is 8.5% interest. So this is my interest on the loan is to be paid every year on 31st March and the duration of the loan is 4 years. Payment will be made annually for 4 years. In the month of October 18, Central Bank of the country releases following projection about the interest rate likely to prevail in the future. So the central bank in our country, RBI, Reserve Bank, has predicted the falling interest rate, that is on 31st March it will be 8.75%, then 10, 10.5, 7.75. They have taken the loan at 8.5% and the interest rates are likely to increase in most of the years. So how this borrowing can hedge the risk arising out of expected rise in the rate of interest when he wants to peg his interest cost at 8.5%. Okay, so this seems to be a floating interest rate loan. It seems to be a floating interest rate loan because as the market interest rate will go up, understand, as the market rate will go up, the applicable interest rate to this company will also go up. So they want to ensure that the interest cost does not exceed 8.5%. Assume that the premium negotiated by both the parties is 0.75% to be paid on 1st October 18. So this is a question of using the interest rate option for hedging the risk. Interest rate option, and your interest rate you want to lock at 8.5. For that you are willing to pay a premium of 0.75 and the actual rate of interest on respective due date happens as follows. So what this company will do, company will buy a cap, which means buy call option. If the interest rate is greater than 8.5%, you will get the difference. If the interest rate is less than 8.5%, option will lapse. Option will lapse. If the interest rate is less than 8.5%, option will lapse. In the first, second and third scenario, the option holder will receive the difference, and in the fourth scenario the option would lapse because it is below 8.5%. But for getting this option you will have to pay what is called option premium, which is 0.75% of the loan amount. So the question is, show how the settlement will be executed on the respective interest due date. You can solve on the calculator also, it is so easy. In the first case it will be 10.2 minus 8.5% of 4 lakh. In second case 11.5 minus 8.5% of 40 lakh. In the third case 9.25 minus 8.50% of 40 lakh. In the last case you will write the option would lapse because it is below the exercise price. And for this basic effort you will get only 6 marks. 6. Okay, let us write a note first. Only directly writing the answer will not give you full 6 marks. So I will urge the student that do some writing practice along with me This is a highly potential question for your exam. Highly potential, write down, highly potential, whichever exam you are going to appear. So first you write a note that as borrower does not want to pay, more than 8.5% per annum, borrower does not want to pay more than 8.5% per annum on this loan, where the rate of interest is likely to rise beyond this, hence he has hedged the risk, by entering into an agreement to buy interest rate cap. Cap means upper limit. You will buy interest rate cap, means buying call option. Okay, buying call option, where if the market goes up above 8.5, then you will get the difference. But if the market goes below 8.5, the option will lapse. You don't have to pay the difference with the following parameters. That is interest rate cap. So what kind of agreement you will enter into? Write down notional principal rupees 4 crore. Is it 4 crore or 40 lakh? Whatever is written, write down 40 lakh. Strike rate 8.5%. This figure you check and write from the question. Strike rate 8.5% means if the market rate is beyond 8.5, the call option holder will receive the difference. Then write down reference rate. The reference rate is the rate of interest applicable to this loan. That means for calculating the difference, you will take 8.5%. For calculating the difference, you will take 8.5%. Then write down calculation and settlement date. If you don't have time in the exam, then don't write so much detail. But if you have time, then write down 31st March, calculation and settlement 31st March every year, and duration of the cap till 31st March 2022. Means it's a 4-year problem. First point, write down the premium to be paid. Everybody please participate. Premium to be paid on 1st October 18 is 3 lakh. Sir, how did you get 3 lakh? 4 crore into 0.75%. I think in the question 40 lakh is typed. So please make it 4 crore. Please make in your question 4 crore. This is the problem of the institute. In their answer also they have made the same mistake. 4 crore into 0.75%. Type 4 crore into 0.75%, you will get 30 lakh, or sorry 3 lakh. Now write down the payment of this premium will entitle the buyer of the cap to receive the compensation from the seller of the cap, whereas the buyer will not have obligation. All these details are given for understanding. If you don't have time in the exam, then write this line and then directly prepare the table. So next line, write down calculation of compensation received by the buyer of caps. Calculation of compensation received by the buyer of caps. We'll make a table with 5 columns. First column, write down date. Second column, write actual rate of interest, which is given in the second table. The first table is not useful, that is only prediction of RBI. Second table in the question is useful. Those are the actual rate which will be required for calculating the difference. Rate of interest. Then third column, write strike rate. Fourth column, write down compensation in percentage. And fifth column, write down compensation in rupees. Very easy question. Write down on 31st March 19. Question in front of you. On 31st March 19, 10.2% is the rate of interest. Strike rate is 8.5. So tell me the difference. 10.2 minus 8.5 is 1.7%. So you will take 4 crore into 1.7%. 4 crore into 1.7%. In the question, just make it 4 crore instead of 40 lakh. So 6,80,000. Then next, write down 31st March 2020. 11.5%, 8.5%. This time the difference is 3%. 3% of 4 crore, 12 lakh. 3% of 4 crore, 12 lakh. 31st March 2021, 9.25%, 8.5%. Very good, Sagar. 0.75%. So now you reply how much compensation will be received. Yes, reply 0.75% of 4 crore. That is 3 lakh. But the important one is the last one, where the student can make mistake. 31st March 2022, 8.25. It is a call option. Exercise price is 8.5. Market rate is 8.25. So what will you do? You will not exercise. Option will lapse. And therefore you will get 0. Now you may forget why I have written nil here after some days. So write a note for that. Put an asterisk mark and write a note. Otherwise, after some days, you may not remember my words that this is an option, and you'll get little confused. So please write down the buyer of the caps. This is a note for this nil. Take an arrow, connect it. The buyer of the caps will not receive the compensation. The buyer of the cap will not receive the compensation, as the actual rate of interest is 8.25%, whereas the strike rate of the cap is 8.5%. Hence his interest liability shall not exceed 8.5%. So that was a good question, because if you have practiced before going to the exam, then you can easily solve in about 4 to 5 minutes and you'll get full 6 marks to 8 marks. But if you have not practiced, then deciding the format, solving may take time. If you want, you can take the total of this last column and that is also okay. You will get 21,80,000. Very good. Now we'll come to question number 6A. This question is again a repeat question based on past exams. Same question they have asked for 10 marks. Very easy. And you must solve it before going to the exam. Bonus mark. Typical portfolio question asked in the exam. Must do it. It's highly repeated. Similar questions are repeated in the exam. So are you ready? Say yes, we are ready. If you say you are ready, then I will proceed further. Details about portfolio of shares of an investor is as below. Shares, number of shares, price per share and beta. So there are 3 companies, their numbers are given, the price is given and the beta is given. The investor thinks that the risk of the portfolio is very high and wants to reduce the portfolio beta to 1.125. You must have done very similar question. He is considering 2 below mentioned alternative strategies. So what are the 2 strategies? One is to dispose of a part of his existing portfolio to acquire risk-free security. So buy risk-free security and sell the shares. That will reduce the portfolio beta because risk-free security has 0 beta. So this is called using risk-free asset. And second is called using future. Take appropriate position in Nifty future, which are currently traded at 5,000. 5,000 and each Nifty point is worth 500. So one lot is equivalent to 5,000 into 500. One contract is equivalent to 5,000 into 500. You are required to determine portfolio beta. Multiply these two, you'll get value, convert into weight into beta. Value of risk-free securities to be acquired, number of share of each company to be disposed of, number of Nifty contracts to be bought or sold. So if you have to reduce the beta, you have to go short on Nifty future so that the loss in share will be compensated by the gain in future. And what will be the value of portfolio beta? Good question. For a 4% rise in Nifty, what will be the value of the portfolio beta for a 4% rise in Nifty, assuming that you have used Nifty future for reducing the portfolio beta. Okay, this question is very important, asked in the exam also. So I will highly recommend you to revise this a day before exam. Question number 6A, question number 5B are some important questions from this MTP. So start, please write down calculation of portfolio beta. Draw this format. Every time they ask you portfolio beta with this kind of data, use this format. Write down shares, name of the share, number of share, price, market value, weight, beta, weight into beta. Okay, question in front of you. We are solving, those who have joined late, MTP April 23 SFM. You can download from our website vino.in question paper and answer. Okay. Number of shares, write down 1065 in lakhs. Question is in front of you. Price per share is given 400, 500, 600. Just multiply price and number 4000, then you will get 3000, again 3000, total 10,000. So your portfolio value right now is 10,000. This number also I will need in my answer. 4 divided by 10 will give you weight 0.4, 0.3, 0.3. Beta is given in the problem. Kindly multiply and take the total. Let us see who will give the answer first. Portfolio beta. Yes, come on. Give me portfolio beta. Final answer. Portfolio beta is 1.5. Very good. Portfolio beta is 1.5. Write down below. Existing beta is 1.5. Existing beta is 1.5. Required beta, desired beta or target beta is 1.125. So we have to find out what should be the weight of risk-free asset so that my portfolio beta is reduced to 1.125. Very good, Sagar. Come on. Now you have to write, let the weight of risk-free asset, let the weight for risk-free asset for desired beta of 1.125, for desired beta of 1.125 BW. Then write down below one equation. 1.125 is equal to 0 into W. What is 0? 0 is beta of risk-free asset into W. If weight of risk-free asset is W, weight of shares will be 1 minus W, and this is the beta of shares calculated in the previous step. So I will ask you to solve and get me the value of W. So the simplified version is now 1.50 minus 1.50 W. After you solve it, W is 0.25, means risk-free asset should have a weightage of 0.25 and shares should have a weightage of 0.75. This will be the weight of shares and risk-free asset. Now the question is, how many shares we are going to dispose for each share A, B, C. Write down next line because that is my next question. Shares to be disposed of. How many shares you are going to dispose of for each company A, B, C to reduce portfolio beta to 1.125. So because you have to bring risk-free asset, you have to sell shares of 10,000 into 0.25, which is 2,500 rupees. And how this 2,500 rupees will be raised? By selling shares of all the three companies A, B, C. And in what ratio you are going to sell? In the ratio of their existing weights, so that the weights of A, B and C will continue to remain same 0.4, 0.3, 0.3. So this 2,400 you will allocate in this ratio. So that will give me the value of each share to be sold. Divide by price will give you number of share to be sold. Very easy mathematics. Come on student, write down value of risk-free asset to be acquired. This is your answer of part 2. Value of risk-free asset to be acquired is equal to 2500. 2500. Now write down next line, number of shares of each company to be disposed of. Number of shares of each company to be disposed of. Number of share of each company to be disposed of. We'll prepare a table for better presentation. Share, weight, amount in rupees in lakh, market price, and last column number of shares. Number of shares to be sold. Number of shares to be sold. So this will give me third answer. Number of share to be sold in lakhs. First write down share ABC 0.4, 0.3, 0.3. Total I have to dispose shares of 2,500 into 0.4 will give you 1,000. 2,500 into 0.3, 750. 2,500 into 0.3, 750. Market price copy from the question book. 400, 500, 600. 1,000 divide by 400. So you will have to sell shares 2.50 lakh for share A. 500, 750 divide by 500. 1.5. Last one do yourself. Last one do yourself. 750 divide by 600. 1.25. So this is answer of part 3. Now next question is number of nifty contracts to be sold. Very easy. Why I have written sold? Because my objective is to reduce risk. If the objective was to increase beta, you will say buy nifty future. The formula is, as we have discussed in the class, portfolio value into existing beta minus desired beta divided by value of one future contract. Very good. Those who are replying, I am very glad. Now you put the values. Your portfolio value in the first table was 10,000 lakhs. Existing beta is 1.5. Desired beta is 1.125. One lot of nifty future contract has a value of 5,000 into 500. So please solve and give me the answer. Solve and write the answer. How many contracts you will sell? How many contracts you will sell? So this time the answer is 150 contracts. This is my answer of part 4. Very important. And the fifth part is even more important. The fifth part says what will be the value of portfolio beta for a 4% rise in Nifty, and you have sold 150 lots of Nifty contract. So if Nifty goes up, shares will also go up. Nifty goes up by 4%, shares will go up by 4 into beta 1.5, 6%. So the value of the share you can calculate, it will increase by 6%. If Nifty goes up and you have taken a short position, you have to pay mark to market margin. You will have to pay mark to market margin, which will be 150 contracts into 5,000 into 500 into 4%. So that will reduce the asset value to that extent, and then we'll have to find out what will be the portfolio beta in that case, and I have to prove that the portfolio beta will reduce to 1.125. okay, write down, very important, write down, very important. Students make mistake here sometime. Calculation of portfolio beta for a 4% rise in Nifty. For a 4% rise in Nifty, under that write down, rise in Nifty 4%. Therefore, rise in portfolio value 4 into 1.50. 1.50 is portfolio beta. This time I don't have risk-free security in the portfolio. I have taken Nifty short position 6%. So portfolio value will go up by 6%. It is 10,000 now plus 6%, 10,600. But then on Nifty you have loss. Short position holder will have loss. So that is 5,000 into 500 units into 150 contracts into 4%, and the amount you have to write in lakhs. Amount you have to write in lakhs. 150 loss. Therefore, value of portfolio after rise of Nifty. Value of portfolio after rise of Nifty. So you will say 10,450, 10,600 minus 150, because you will have to pay mark to market margin. Now write down percentage change in portfolio. Percentage change in portfolio. Your portfolio was 10,000 and now it is 10,450. Your portfolio value has changed from 10,000 at the beginning to 10,450. So can you tell me percentage change? 450 is the change divided by 10,000. 4.5%. 4.5%. And what is the percentage change in Nifty? 4% already given. These two are same. So now you have to find out beta, portfolio beta after rise. 4% change in Nifty is 4.5% change in portfolio value. Change in portfolio value divided by change in Nifty value is the portfolio beta. Change in portfolio value. Very good, Sagar. 4.5% is right. So now my answer is 1.125, and you will be happy to note that this is equal to desired beta. Okay. So in the exam you have to cross check this. In your institute answer, which they have printed by mistake, they have printed I think 1.5. If those who are relying on the institute answer, please rectify. It is 1.125. That is the purpose. of selling Nifty future to reduce the beta. So next question number 6b. This is the last question I am going to solve, and what you do, all theory question you revise from MTP solution. Okay, theory questions are also important because 20 marks theory question you have to write in the exam. Every question has one theory question of 4 marks. So 5 into 4, whether you like it or not, you will have to solve 20 marks theory question. Question number 6b. Ram. Hey Ram. Jai Shri Ram. Radhe Shyam. Ram holding shares of Reliance Industries, Shabash Ram, which is currently selling at rupees 1000. Selling price is 1000. He is expecting that this price will further go down due to lower level of profit than expected level to be announced after 1 month. So what is the expectation? Expectation is price will fall, because only if you know the expectation you will take a correct position in the option market. As on the date, falling option contracts are available. So these are the strike prices, and these are the call options, these are the put options, and these are the premium available for different strike prices on call and put. You don't have to use the entire table, you have to only use the relevant figure. Ram is interested in selling his stock holding as he cannot afford to lose more than 5% of the value. So value of the share is 1000. He don't want to lose more than 5%. So he wants to receive in any case 950 after 1 month. In any case he wants to receive 150 after 1 month. Okay, so 5% loss he can afford. So he doesn't want to get less than 950 after 1 month when he is going to sell. Recommend a hedging strategy. Very good question. This is also past question, already asked in the past exam or past RTP. I have seen this question. It is there in our study material also. In this MTP, all questions were from past exam, RTP, MTP. That is a summary. No new question was there. Recommend a hedging strategy with option and show how his position will be protected. And show how his position will be protected means he will not have to pay more, he will not receive less than 950 when he will sell the share. So when you are expecting that the price will fall, what you can do, you can either write a call or you can buy a put. You can write a call option or you can buy a put option. So what we will do, here's reply what we will do. Anybody, any answer? So what we will do, we will buy a put option at exercise price of 950, because if the price falls below 950, we will be able to sell the share at 950. But at the same time, if the price goes up, we will enjoy the benefit of that. We will enjoy the benefit of that. Okay, if you write a call option and if the price falls to 930 rupees, The call will lapse, but then you will be able to get only 930. Okay, in the market price can go down to 900 rupees also. These are the strike price. Actual price can be anything. So writing a call option will not be a good strategy. Buying a put option at 950 exercise price will be a correct strategy. So student will write in the exam first like this. This is a test of your understanding of option chapter. Ram should cover his risk by buying a put option. The first thing, you should buy a put option. When you are holding the stock, you want to cover yourself by using option, buy put option. Ram's risk appetite is 5%. Second line, Ram's risk appetite is 5%. So the strike price shall be 950. How did you get 950? 1000 minus 5%. Now I am going to prove that with this strategy I am definitely going to receive 950 by selling the share. So next line, write down calculation of overall position. Calculation of overall position. So there are two possibilities on expiry date or after 1 month. There are two possibilities after 1 month. Either the share price can be less than 950. Either the share price can be less than 950 or the share price can be greater than or equal to 950. Or the share price can be greater than or equal to 950. Let us see what happens in these two scenarios. Either it is less than 950 or greater than or equal to 950. So the value of the stock will be equal to whatever is the market price, that is S. If share price is 500, you will get 500. Share price is 850, you will get 850. Share price is 1000, you will get 1000. But what about the put payoff? The value of the put is, you have studied in the class, higher of E minus S or 0. E minus S. What is exercise price? 950. Put will be exercised because market price is less than 950. Here the put will be exercised and you will receive 950 minus S. But if share price is equal to or more than 950, put will lapse. And since put will lapse, you will get 0. So what is my premium to be paid? Premium to be paid is 8 rupees at the beginning. So that is not dependent on what will be price on expiry. Now write down net payoff. Add these three numbers. This S minus S will be cancelled. This is 942. This is S minus 8. So you will get a minimum 942. You can get more also if the share price is more. So write down the value of Ram's holding shall never be less than. The value of the Ram's holding shall never be less than rupees 942. Value of Ram's holding shall never be less than 942. Shall never be less than 942. Put will compensate for the loss. Put will compensate for the loss below spot price of rupees 950. Put will compensate for the loss. So if your price goes below 950, put will compensate for that loss. So this column can never go down below 942. But then why there is a difference of 8 rupees? The difference of 8 rupees, the premium that you have paid. So that is the cost of hedging. However, this strategy will cost rupees 8. However, this strategy will cost rupees 8. Okay. So this strategy will ensure that you will get 950 rupees minus 8 rupees because that is the cost of hedging. You can get more also. You can get more also. For example, here if the share price happens to be 1500, you will get 1492. You will get 14. So minimum 942 you will get, but you can also get more than that with this strategy. So this is the benefit of learning option. You can hedge your risk that you are holding certain shares. Okay. So this was the answer of question number 6B. We thank you very much for watching this lecture. Please subscribe to our YouTube channel ES Foundation, and you also like the video, but most importantly you share the video with your other friends and ask them to watch. I have uploaded SFM MTP March 23, SFM April MTP which is right now going on, and SFM RTP also for May 23. Plus I have also uploaded revision lectures, about 30-40 hour SFM revision part 1, part 2, SFM theory revision part 1, part 2 is there on our channel. So that is a very good content and you can enjoy it. I repeat that please do not follow that ABC technique for SFM. Any question from any corner of the chapter can be asked. Like this MTP you have seen, it covers a wide range of questions. Shortcut will not help you. No amount of shortcut tricks will help you to get through this SFM. Practice and more practice is required for getting through the SFM exam, and you have to solve a variety of questions. So thank you very much. See you again soon. Bye.